This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of Monday, March the 13th. A crazy week in the precious metals, but across all markets as the banking crisis and crisis of confidence in the banks begins to worsen, not only here in the U.S., but in Europe as well. It's going to be a story all week long. Coming into Monday, it was already quite the story, and we had a heck of a day, not just in gold and silver, but in the bond market as well. Some truly historic moves in the bond market. And the chart you have here for Monday, March the 13th, is the yield on the U.S. 2-year note. That inversion versus the 10-year was a sign that economic recession was coming. The flattening of that inversion, which began in earnest last week, is a sign the recession is here. This has major implications for the precious metals, and that's why we keep an eye on the bond market. Now, a 2-year note chart was one that we were looking at, again, on Monday, March the 13th. First of all, this one's suitable for framing because you're not going to see this again anytime soon. Yield on the 2-year note, again, 3 days ago. This shows it almost to 510, 509, and that might be right, not 505. Big time down Thursday, big time down Friday. That little green thing is showing you the trade yesterday, Sunday night, and then today. Again, from 4.5 at midnight last night to 398 when I printed this. Back down even lower than it was back in early February when gold was 1975. Gold, again, 1918 as I speak. As you likely know, one of the major contributors to daily volatility in the precious metals is the dollar index. A rising dollar can be a wind in your face. A falling dollar might be a wind in your sails. So we keep a close eye on it every single day. And at present, the dollar index trying to hold its 50-day moving average as support. So we're going to watch it closely in the days to come. And it was one of the charts we discussed on Tuesday, March 14th. The dollar, like I said, trying to hold above its 50-day moving average. After spending all that time below it, finally slugging up against it in first part of February, took 7 or 8 days to finally get above it. And now here it is back trying to test it for support. It might hold as support and then start moving higher again. Hell, that's a possibility. So we'll watch. 2 days in a row, it has found support at the 50-day. Tomorrow, with all that data, maybe that'll be enough to wash it out and drop it back below 103 and below the 50-day. But let's watch this really, really closely. Really, really closely tomorrow and the rest of the week. Of course, it's the precious metals that are our primary focus at TF Metals Report. It's been that way for nearly 13 years now. And gold certainly has our eye here this week. It is a safe haven, but also reacting to this change in Fed policy, loosening, no more quantitative tightening. You knew this was coming, and now here we are. Gold chart turning up, already having a heck of a week when we talked about it on Wednesday, March the 15th, and it's going to be a big focus going forward too. But as of that day, it was just chugging higher and certainly had our attention. What does that mean on the daily chart? It looks pretty good, doesn't it? Yeah, look at that little double bottom in that area that I was telling you to look for support. Yeah, okay. Maybe the blind squirrel finds a nut every once in a while, but all the way down in February, he said this would be the area. Now, again, granted, after Powell got done and when silver failed to get back above its 200, I was pretty nervous that we were going to break the 200 and run down here to 1780, even 1760. But instead, who could see this all coming? Look at this massive, massive rally now. What is that, 5 days? Looking pretty good. And again, above 1900, above 1920 even. Let's watch 1940. As you can see in late January, that was a level that was holding a support. And above 1940, we should be right back to 1970, those levels we got to at the end of January. And why wouldn't we? Isn't this a more bullish picture than what everybody was hoping for at the end of January? Our Thursday Conversation podcast this week, which is always free right on the TFMR homepage. You can just go there, grab the link, and give it a listen. And I would sure encourage you to do it this week because this week's guest was John Titus, an old friend of the site. John does tremendous work, really forensic work on central banks, their scams, the lies they tell, and where we are right now in this renewed banking crisis with everything that's going on. We could not have had a better guest than John Titus. And here's just a snippet of what he had to say on Thursday.
I mean, the rule is, if you have north of $250,000 in your account, you're exposed. But what makes Silicon Valley Bank different is that the vast majority of its deposits, something like 72, maybe even depending on what source you use, up to 90% of the deposit base is sitting north of $250,000. And I must remind you that during QE, during the pandemic, when the Fed ginned up $5 trillion out of thin air, it bought assets from non-banks. And the reason it did that, Greg, was it had these non-banks, say, for example, BlackRock, had things like treasuries and mortgage-backed securities sitting on their balance sheet, and they didn't like them because they were low yielding. So the Fed said, okay, we're going to give you cash because you can't really sell these out in the open market. You're not going to get a good price for them. We'll give you a good price for them. And then what you can do is you can turn around and you can invest that thing. You can invest the cash that you have now into things like the stock market and SPACs. And so a lot of Silicon Valley players and tech startups and whatnot, they benefited from pandemic QE, right?
Right.
But they kept their money. They kept all this new, freshly printed money in single, bank accounts north of $250,000. Okay. So they got bailed out once, really. They benefited from pandemic QE, and now they're getting bailed out really a second time. So what's going on is just, we don't have the rule of law anymore.
Right.
They just make up these rules. They don't enforce the rules. They enforce them arbitrarily. But this time they are benefiting the people who already benefited from pandemic QE. That's what's going on here.
And on Friday, March the 17th, happy St. Patrick's Day to everybody. Hey, we are wearing the green in the COMEX metals. Gold surging to its highest close of the year, and actually its highest close since April 22nd of last year, pushing towards $2,000 an ounce on renewed fears, not only of the banking crisis here in the U.S., but Credit Suisse and contagion fears in Europe. It is going to be a very interesting week next with the next FOMC meeting concluding on Wednesday. But what is the world going to look like before then? You should be watching as soon as Sunday night. The futures begin trading again at 6 o'clock Eastern. There are multiple sites you can track them on. Investing.com is the one I use. You might want to be paying attention Sunday night to see how things are trading. But here on Friday afternoon, as we go to wrap up what has been a crazy week with gold up more than $100, take a look at this chart. It's above both moving averages. The 50-day moving average is turning up as well. $2,000 is clearly in its sights. And as you know, that's a very important technical and psychological level. So we'll be watching very closely all through the week next week. And like I said, it's going to be a crazy one. So I hope you enjoy your weekend. Get a chance to get some rest. Maybe join TFMR when you get a chance. Again, it's only $15 a month. But either way, make sure you're paying attention next week, and then come back next Friday for another edition of the TF Metals Report podcast highlights.